And when they roll it in, do they start all over at 30 years or do they just start where they left off?
You have a choice.
Mm.
So it really depends on what your goals are. So if you're resigned that you're going to be paying a mortgage payment for the rest of your life, there's no reason not to. There's no reason not to have the lowest payment that you possibly can. But it's
awesome. Well, hey, everybody, it's me, Ashley with Keller Williams. I am super happy to be here with one of my lending partners, Miss Nikki Benson. I'm going to let her tell you a little bit about herself, but before we get started, we're going to talk about refis. And man, I'm excited for this video. So Nikki, take it away.
Thank you. I'm very excited to be here. Thank you, Ashley, for having me. I'm honored and humbled at the opportunity. I have so much respect for you and the work that you do and your reputation in the community.
Thank you so much.
I am, in case you're wondering, because Black don't crack, I'm 37 years old. I started in the lending industry. I started as a bank teller in 2001 and became a lender in 2004. I got licensed to help people buy homes in 2012. Also to help people refinance in 2012, and became a first-time home buyer instructor in 2013. I've been at Caliber Home Loans since 2015, and this past year, 2020, humbled to have helped 127 families with financing.
Wonderful.
96 of those I helped buy homes, which 80% of those were first-time home buyers. So I'm very grateful for the people I've been able to serve. I was just admitted to the Scotsman Guide, so I do believe I will be noted as a top 1% lender in the country. And I do know for certain that I am in the CEO circle of Caliber Home Loans, which represents the top 1% of lenders at Caliber. So
wonderful.
That's a little bit about me.
Yay, that's awesome. So where can people find you? Like, are you on Instagram and stuff like that?
I am, as a matter of fact. I brand myself and my team as Boss Lady Mortgage, and you can find me on Instagram at Boss Lady Mortgage, and you can find me on Facebook at Nikki Benson. I connect with people on my personal page more so than my business page, but yes, please do connect with me. I love to socialize on the internet.
We all do. All right, well, let's get to the nitty gritty. I mean, I think that there's been a lot of refining happening because rates have been so low. And I just really wanted to give people an idea of what refis are, because a good percentage of people haven't refied despite the fact that rates are super duper low right now. So maybe we can just start with that. What is a refinance?
Yes, a refinance is when you currently own a home and you take the finance that you already have and basically redo it. And you can redo it in a number of ways. You could be, I know one of the questions is what are the types of refinances, which is leading into that. You could do a rate and term refinance, which means that we're refinancing the original purchase loans that you got to buy the house. It could be, you could have gotten a first loan or a first and second to buy it. You can refinance them both and call that a rate and term. A cash out refinance would be something where you're utilizing your equity for whichever purpose you like. You can do, you can pull cash out to make improvements on your home. You could pull cash out to pay off other debts, which could be a great opportunity if one may have credit card debts or car loans. If any of those are hitting above 3% interest rate, it might be a good idea to use the equity in your home to lower the interest you're paying on your overall debt load.
Yeah, great. And then there are a couple of other ones, right? You could do, people might want to do a cash in. I don't know how common that is.
Cash in refinance, you could do that. Actually, I am doing one of those right now where someone had a jumbo loan or a loan that was originally at $800,000 and being able to pay some money down on that is going to be reducing their, and it's like maybe $30,000, but it's overall going to reduce their payment per month by $1,000 a month.
Wow.
So that is also an opportunity to do a cash in. You know, I've never heard it phrased like that, but yes.
Yeah, and then consolidation, right? I think like if you had like a HELOC or something, you might want to combine the two.
So that's what we would call, debt consolidation. That would be part of a cash out refinance that you could do to, you know, pay off any debt, including a HELOC. But if you were to have gotten that HELOC at the same time that you purchased the house, so let's say you had a first and second at the same time,
right,
which some people do. If you refinance those at the same time, that would be a rate and term.
Oh, okay.
But if you got the HELOC after, even one day after the purchase, that would be considered a cash out refinance for debt consolidation.
Yeah.
Which you might as well pay off the student loan and a car loan while you're at it. If you have to be.
Yeah, it's true. It's true. Yeah. So that's interesting. Okay, so let's see. And what do you think is the most common one? Is it the rate term?
I would say that's the most cost effective.
Okay.
When you start pulling cash out for any reason, it gets a little bit more expensive. And that you'll see that more in the interest rate, or that could be translated in cost to close the loan. But it really is whatever the purpose of, or what you need the money for.
Right.
You know, or if you need it at all. You know, if it's just taking advantage of a lower interest rate, then yes, we go rate and term all day long. But if you do have a need for utilizing your equity, right now is a great time because it's likely it would be the cheapest money that you could borrow.
Yeah, that's right. Mm-hmm. Cool. Okay, well, maybe we can talk about like pros and cons. I mean, I don't know. What do you think? I mean, this is going to be really specific to an individual circumstance, okay? But maybe we could use a rate and term just for illustrative purposes and maybe talk about what's great about it and maybe what's not so good.
Okay, so the only con, I'm going to start with the con because, I mean, it's really subjective, but the only con for a refinance is that there are closing costs for it. So the closing costs, they could range between $2,800 to $3,500 on average for any given person. So you have to look at what is the amount of money you're saving on your monthly mortgage payment, and then how much is it that you're paying for the refinance. And then you do an easy division to say, okay, well, the cost of this refinance is going to pay for itself in 12 months or in 24 months or 23, you know, so, and so forth and so on. So if you're planning to sell your home before the cost of the refinance pays for itself, then that would not be a cost-effective solution. Pros to it, though, are, you know, if you plan on staying in your house for longer than it takes to pay back the cost of the refinance. So if it's 12 months cost to recover, 12 months to recover the cost of the refinancing your monthly savings, and you save it a month longer than you saved on your cash flow, and you've done an overall savings. However, the experience of the refinance, it feels like, at least how I do it, it feels like it doesn't cost you anything, and you're getting money back, and you're saving on your monthly payment. Mm-hmm. And how we do that is we can often roll in the cost to refinance into the mortgage payment, and you're still having a savings, or I should say into a mortgage loan amount, I should say. So if your loan amount was $200,000 and then you refinance it and now it's now $206,000, if you're saving $125 a month, what that feels like is that the loan didn't cost you anything to refinance, and now you're saving every single month.
Right. So I guess, did you have any other pros? Because I'm going to move on to the next thing.
Pros, I would say too, if you're never going to refinance again, which some people might not have to with this current market,
Right.
you could save a lot of money over the life of the loan. Lots, like tens of thousands, some people $100,000.
Yeah.
Because it's surprising when you see if you're going from a 4.25% rate down to a 2.99, how much money that's going to save you over 30 years.
Yeah, it's incredible.
It is.
It's incredible. Okay, so let's talk a little bit about the cost. So, I mean, you kind of mentioned it's like, let's call it like $3,000 to refi. So what are the options for paying that? I mean, you said you could roll it in. I guess it's pretty simple.
Yeah.
Roll it in, pay it up front.
You could pay it up front, or you could roll it in, or you can do a combination of the two.
Okay. Okay.
Yeah.
And then do people usually like try to, like, can you at that point buy your rate down even more? Like, could you pay?
Absolutely. You could also roll that into the loan amount. So you could say, well, we could say, okay, your rate's going to be 2.99 without costing you anything. But if you want to pay $2,000, you could have a 2.875, and they could say, okay, great, I'll pay that. And then you say, okay, we'd like to add it to your loan amount. They say yes. It's like, okay, here's your overall savings at that amount. You still, that can be alluring because you can, go all in, but you have to still consider how long will it take to repay the cost of this refinance, and what's the likelihood of you refinancing again or selling the home. Because if you have a project in mind, let's say you want to redo the roof and you might want to do that in 5 years, you might want to pull equity out from your home to be able to finance that project. So if you're going to do a refinance again, you wouldn't want to pay so much in points that it would take you 7 years to recoup the cost of the refinance.
Right. But it sounds like there's options.
There's all sorts of options. We can do just for you.
Well, what do people most commonly do? They most commonly roll it in. Yeah. Okay. And when they roll it in, do they start all over at 30 years, or do they just start where they left off?
You have a choice. So it really depends on what your goals are. So if you're resigned that you're going to be paying a mortgage payment for the rest of your life, there's no reason not to have the lowest payment that you possibly can. But if your goal is to pay it off within a certain amount of time, we can easily do a 30-year fix with a 25-year amortization, or we could do a 25-year, we can set the amortization as long as it's less than the fixed term that is priced for. So you could do a 30-year fix with a 15-year amortization schedule. Yeah. But I mean, at that point, of course, you do a 15-year fix that has a lower payment or a lower interest rate. But oftentimes how it comes into play is if, let's say you just got the house a year ago and you're like, I don't want to start over on my pay. It's like, okay, great. We'll do a 30-year fix, 29-year amortization schedule. Yeah. Easy. Well, cool. Well, do you have maybe like an example you could run us through? And I mean, I guess, and when you're talking about this example, like what are kind of like the pitfalls? Like what might make a refi not go through, or like what are some common things where it's like, this refi didn't work out? Why is that? Okay. Do I have the option to, please give me the option to share my screen? Yeah, let me see here. I think I just have to. There we go. All right. So here is an example of a refinance. Let's say this is someone who purchased their home. This is, I do this comparison for people, let me just open this up here a little bit. This is great. So I show, okay, this is what your credit score was. This is what the value was when you purchased the home. This is the loan amount when we purchased it, etc. So this was your interest rate. You're paying mortgage insurance of this much. This is your principal and interest that was fixed. here, I always show their current taxes and insurance and then what their payment currently is. Because if we're comparing, there's no need to compare taxes from 2 years ago because they're not paying those. So
right.
I look at current taxes and insurance based on what they're paying and then map that over. Really, it's like, here's the numbers that would change is that if their mortgage insurance, if that might go away, and then principal and interest, everything else should remain the same. So, but this amount as far as loan to value adjusts to 1. You see the loan amount here doesn't change much.
No. But
the value of the house has increased. So taking advantage of the increased value of the home can save you money on mortgage insurance and on interest rate. So if you're going from 85% loan to value down to 76, that gives you an opportunity to increase your savings. So here is where I had them priced out, going from a 4% down to a 2.99, also removing mortgage insurance. It took their payment from $2,393 to $2,092. So that is $301.44 in savings. Yeah. So I only look at the cost of the loan, not the taxes and insurance savings, because you don't get that back. Yeah. But if we put in the $301.44 into the amount of the closing costs, they're recouping the cost of the refinance in 12 months. Yeah. So this shows, okay, if I'm going to live in this house for longer than a year or have this loan for longer than a year, right, it makes financial sense to do a refinance. Yeah. Again, we can roll this into, so this is, I have the current loan amount here, and then I have an estimated payoff based on the interest rate that they were paying before, right, adding in closing costs and escrow deposit. So it brings the new loan amount only
oh, I see.
About, yeah, 1,000 or so less. So it's like rolling everything in. They don't have to bring any cash to close, and they're saving $301.44 a month.
Yeah, right off the bat.
So what that feels like is I don't have to pay anything for this refinance, and right, I get to save $301 a month. Right. That sounds like a great deal. And on top of that, whatever money they had in their current escrow account, they're going to get mailed back to them 21 days after we close. So they're going to get a check in the mail of potentially $3,000, mm-hmm, which and they start saving on their mortgage payment immediately, which that goes into the next question of when's my first mortgage payment.
Yep.
So if we were going to close on your refinance today,
right,
your next mortgage payment would be the following month. So you skip a month. Yeah. So, mm-hmm, I'm not sure when someone will be viewing this video. So it could be, today, it could be.
Yeah, well, today as we stand, it's January 26th.
Yeah,
so
January
if we were closing
26th.
Today, it would be like March 1st, right?
It would be March 1st, exactly.
Sweet.
So what that feels like to a person is, 1, I get to skip a month's mortgage payment.
Oh, yeah.
Awesome.
Vacation.
Oh, on top of that, I get a check in the mail for $3,000. That sounds like I saved $2,300 plus got $3,000 in the mail. And next time I pay my mortgage, I save $300. Mm-hmm. It's like, hello, give me a lobster dinner up in this piece.
Yeah. So why don't they just keep that money in escrow? Is it because the closing costs, or?
We could do an option that if you're a current Caliber customer and you're refinancing at Caliber, we have a netted escrow option, which basically means we lower your payoff and then lower your initial. So it would basically be lowering the loan amount by $3,000. So it kind of,
which is kind of like, who cares about that? You probably take the cash, would be better.
But if you're switching from a different servicer to Caliber Home Loans, then we start a new escrow account for you because we'll start administering your taxes and insurance payments.
I see.
So that means you start a new account for that, and then your last servicer will be sending you a check in the mail of your.
Man, I'm excited, dude. Just seeing those numbers got me excited. Ashley. I'm excited. $3,000, $5,000 bucks. Whoa, I can do something with that.
Yes.
That got me excited. I'm all like, man, what can I do with $5,000? Send it on over. That's awesome. So let's see. So we did cover the kind of rapid fire questions, most of them. I did have a question about, and this is, I think, a bit of like a rabbit hole, but So they would know their final rate. Like they would lock it at some point, right? So how far into the process do they need to be in order to be like, okay, I'm locking this one?
I ask my clients to leave it up to me.
Okay.
Just because I look at the market constantly. I have market updates on what's happening with interest rates at 6 a.m., at 9 a.m., 11 a.m., and 2 p.m. So if something's happening with the market that could be detrimental to the interest rate, I look and lock. But you could technically lock in as soon as your application is accepted.
Okay.
However, the longer you lock your interest rate, the more expensive it is. So you could be getting a 3.125 interest rate, where if you wait to lock it until the very end, you could get 2.99 at no cost. But if the market's heading in a direction that's not favorable, or if it would just make you feel more comfortable to know that your terms are set, you can lock anytime you choose.
Yeah. Well, that's awesome.
Yeah.
Well, let's see. I mean, I think that's all of my questions. I'm trying to think if there's anything else. Is there anything else that's like a common pitfall that people, they do this thing and it's like, oh, why did you do that?
I mean, just don't go out and get new credit while you're in a financing transaction. Like, don't go buy a new car. Don't go get a new credit card. You know, those types of things are pitfalls, which is the case if you're purchasing or refinancing. But a thing that could happen that could make a refinance fail would be if your income's changed and you haven't disclosed that. That could be something. If you've been affected by COVID during your transaction, if your health or your employment's been affected by COVID, that could be a problem. Or something that could also happen is if we're reaching for your loan value. So like, and the appraisal comes in lower than we're hoping. We do have options for doing a reconsideration of value, which means if we can say, hey, appraiser, look at these comparables that I have or recent sales in the area with similar characteristics of your home that support the value that we submitted, we can ask for the appraiser to reconsider.
Do you think those are successful? Like, how often do you get those and you're like, yeah?
Reconsideration of value? Sometimes, it just really depends. I rely on people such as yourself before I send in a reconsideration of value to say, hey, can you find a better comp for me than the ones that they use?
Right.
But if we go uneducated, then we typically come out on top, figure it out one way or the other.
Yeah, well, wonderful.
Yeah.
Oh, wonderful. Well, I mean, I think that's it. Did you have anything else to add about refis?
No, just that if I have an opportunity to humbly do a plug, is that
please.
Just that relationships are our business. So whether a person's doing a refinance or a purchase, I mean, I'm so happy to help people save money on their mortgages. And I mostly help people buy homes too. So if anyone out there is seeing this and they were like, oh my goodness, she's such a great professional and Ashley's so fantastic, this person mentioned that they wanted to buy a house, please connect them to us, because that's how we support our families, is through word of mouth and your endorsement.
Absolutely. Well, awesome. Well, thank you so much for sharing all of your wisdom. I mean, your experience. It's great.
It's my honor. It's an absolute honor. And come on for two powerful women of color.
Yeah, right.
Say it.
Right. Well, awesome. Well, awesome. Yeah. And I think that's it. And look, if you have not yet subscribed to the channel, like it, subscribe to it. There's good information out there. If you have any questions for either Nikki or myself, our contact information will be down below. And please leave comments, and we'll be back again.
Yes. One disclosure now that I know this is on YouTube is rates are subject to change at a moment.
Yeah, full disclosure.
These interest rates as an APR.
Yeah, that's right. Rates go all over the place every day. So
yes, and so do APRs. So
yep,
there we go.
yep.
I think like
There we go. I think we covered that to death.
yes.
Yeah.
Thank you so much.
Wonderful.
Thank
Yeah,
you.
thank you. Thank you.